Is Elon Musk's latest warning about the banking crisis a wake-up call for the world, or just another one of his wild predictions? Get ready to find out the shocking truth behind the man who's reshaping the future of finance. Elon Musk, the man who has revolutionized the automobile and space industries, has now set his sights on a new target, the banking industry. In a recent series of bold tweets and public statements, Musk has thrown down the gauntlet, warning that the current banking crisis could be just the tip of the iceberg. As one of the most innovative and outspoken thinkers of our time, Musk's words carry enormous weight and have ignited a fierce debate about the future of finance and the global economy. So what exactly has got Musk's hackles up? And what could his warning mean for you and me? Get ready for a wild ride as we delve into the electrifying world of Elon Musk and his latest warning about the state of banking. The collapse of Silicon Valley Bank has continued to fuel crisis of confidence in banks, with no indication of it subsiding anytime soon. In simple terms, a crisis of confidence in banks happens when people lose faith in the ability of banks to keep their money safe and to operate in a stable and trustworthy manner. This loss of trust can be triggered by various factors, such as a bank's insolvency or bankruptcy, fraud, mismanagement, or a broader economic downturn. When people start withdrawing their money from banks en masse, it can lead to a domino effect where other customers follow suit, causing the bank to collapse. This, in turn, can cause widespread financial turmoil. It's a bit like a game of Jenga. Once the bottom block is removed, the whole tower can come crashing down. This is what happened with the Silicon Valley Bank. The market pressure on regional bank shares is a reflection of that crisis, since they've lost billions of dollars in value since March 10th. Silicon Valley Bank, or SVB's failure, at the time was the second greatest in US history, behind Washington Mutual's collapse in 2008. Emergency measures taken by regulators have not yet brought peace. All deposits at SVB, including those over $250,000, were insured by the Federal Deposit Insurance Corporation, thereby lifting the cap. Following the SVB collapse, the Fed has established a new credit instrument called the Bank Term Financing Program to protect the financial institutions. Eligible depository institutions, banks, saving institutions, credit unions, etc., can get loans from the facility for up to a year with collateral in the form of US Treasury securities, agency debt, mortgage-backed securities, or other qualified assets. Despite the rise in interest rates over the past few months, these assets will be accepted as collateral at par value, which is the same as their initial worth. Long-term bonds that were purchased when rates were low are now worth less due to the increase in rates. The Federal Reserve would rather not see financial institutions liquidate their bonds at steep losses. Yet this isn't sufficient. Investors are still worried about a contagion and whether or not the regional banks have any more nasty shocks in store for them. Some of these financial institutions also have bonds they bought while interest rates were low. The trend in interest rates has an adverse effect on bond prices. Banking institutions assumed no credit risk by purchasing the bonds because the likelihood of default by the borrowers was low. However, some of the banks, SVB included, did not effectively manage market risk by continuing to hold onto the bonds even when interest rates rose, causing the bond's value to fall. Several professionals believe that the regulators ought to take action immediately, as the administration has already rejected the concept of a politically fraught bailout similar to the one in 2008. The question becomes what kind of action is warranted. The subprime mortgage crisis of 2008 was mitigated thanks to a government bailout of the banking sector, which has been necessitated by the industry's catastrophic missteps. Regulators don't want to go through the trouble of doing it again because it was and is politically unpopular. To illustrate the significance of regional banks in business and industrial lending and residential real estate financing in the United States, a user on Twitter recently tweeted the following statement. The user reasoned that a depression in the economy is possible if no action is taken. The user warned that another big slump would occur if the Fed did not intervene to prevent the collapse of regional banks. The commercial and industrial loan market in the United States is dominated by large financial institutions, 50%, while residential real estate loans, 60%, business real estate loans, 80%, and consumer loans, 45%, are dominated by small and medium-sized banks. The user cites charts created by Goldman Sachs analysts using FDIC data to back up their claims. Musk felt this to be sufficiently concerning that he commented on it. "This is a serious risk," the billionaire said. The billionaire's worry is shared by many other powerful personalities and economists. They're worried that local banks will be hesitant to lend money. An extreme slowdown in economic activity is possible if individuals and firms have trouble attaining loans. To prevent this from happening, talks have centered on increasing the maximum amount of a deposit that can be insured. There are others who would like to see the FDIC back deposits of any size. Some have suggested raising the cap from $250,000. Others would like to see it at $1 million or $2 million. According to the March 18 proposal from the billionaire, FDIC has to move to unlimited coverage to stop bank runs, and Treasury needs to cease issuing outrageously high-yield bills, making it make no sense to put money in a low-interest rate bank savings account, the time being now. At the height of the Great Depression in 1933, when the American labor force totaled 12.8 million people, around a quarter of them were unemployed, according to the Labor Department. Yet this wasn't the first time Musk had commented on the demise of SVB on his own social media channel. He likened the bank's demise last week to the Wall Street crash of 1920s, which ushered the Great Depression. Tesla's CEO recently commented, "A lot of current year similarities to 1929," in response to a thread started by ARK Invest CIO Cathie Wood. Earlier this month, Silicon Valley Bank collapsed when clients withdrew savings en masse after the bank reported a $1.8 billion loss on the sale of a bond portfolio. The Federal Reserve raised interest rates to try to bring inflation down to its 2% objective, which had a devastating effect on the portfolio's value. The First Republic Bank in California has become a focal point in the emerging regional financial crisis. On Monday, shares of the company plunged again after S&P Global lowered its credit rating to junk status. According to the Wall Street Journal, JP Morgan Chase CEO Jamie Dimon is coordinating with other large banks to support First Republic with even more financial aid. The San Francisco-based lender had a $30 billion rescue plan developed by competing banks just last week. Last week, Fitch Ratings pointed to First Republic's concentrated concentration on rich clients in urban coastal locations as a potential weakness for the bank. First Republic's credit rating was also lowered by Fitch, which put it in the junk category. Now, let's take a look at some of the key reasons why the banking crisis can lead to something bigger. One of the primary roles of regional banks is to provide credit to small and medium-sized businesses, which are often the engine of job creation and economic growth in local communities. These businesses rely on loans and other forms of credit to finance their operations, invest in new equipment or facilities, and expand their business. If customers lose confidence in regional banks and start to withdraw their deposits, it can create a liquidity crunch that limits the ability of these banks to lend to businesses. This in turn can lead to a contraction in business activity, job losses, and reduced consumer spending, which can have a negative impact on the overall economy. Moreover, regional banks often have close relationships with local businesses and are more familiar with the unique needs and challenges facing these enterprises than larger national or international banks. If regional banks fall or experience a crisis of confidence, it can reduce the availability of credit and other financial services to these businesses, which may struggle to find alternatives. Secondly, regional banks are interconnected with other banks and financial institutions, both nationally and internationally. If a regional bank experiences a crisis, it can trigger a chain reaction that spreads to other banks and financial institutions. This can create a systemic risk to the entire banking system, which can have severe consequences for the wider economy. For example, during the 2008 financial crisis, the collapse of regional banks and mortgage lenders triggered a broader banking crisis that had a profound impact on the global economy. Finally, a crisis of confidence in regional banks can have broader implications for the financial system as a whole. Banks and other financial institutions rely on public trust to operate effectively, and a loss of confidence in regional banks can lead to a loss of trust in the broader financial system. This can cause investors to pull out of the market, exacerbating the crisis and leading to a broader economic downturn. In conclusion, Elon Musk's recent call for the Federal Reserve to change course in its fight against inflation highlights the concerns that many prominent figures have about the state of the US economy. Musk's warning about the potential impact of the banking crisis on the economy serves as a reminder of the need for policymakers to remain vigilant and proactive in managing the country's economic health. As we move forward, it's going to be important for leaders in government and business to work together to address these challenges facing the US economy, and to ensure that we continue to promote stability and growth for all. That pretty much wraps this video up, guys, so thanks for watching. What are your thoughts about the ongoing banking crisis? Share with us in the comment section below. Make sure you subscribe to this channel with a bell notification if you enjoy watching our content. We upload some awesome stuff here which you'll definitely enjoy, so hit the like button on this video and leave a comment below. See you guys in the next one.